Let me ask you something. Why do most traders blow up their accounts in the first year?
Bad strategy?
No. Worse than that.
Overtrading?
Closer. But still not it.
Okay. So what is it then?
They start trading without understanding 7 core fundamentals. Not indicators. Not secret strategies. Fundamentals.
So you're saying it's not about finding the perfect setup?
Exactly. It's about not destroying yourself before the setup even works.
That's interesting. So today we're breaking down the 7 things every trader must understand before risking real money?
And if you're trading right now without knowing these, this might actually save your account.
You know what's crazy? Social media makes trading look so simple: a laptop, a beach, a few clicks. And money.
Yeah. But nobody posts the months of losses, the frustration, the self-doubt. The days you feel like giving up.
I remember my first few trades. I thought if I just learned one good strategy, I'd be consistent.
Exactly. I was obsessed with entries. Perfect entry, best indicator, clean chart. But I completely ignored what actually matters.
Like what?
Risk. Position sizing. Emotional control. Expectations. I was focused on winning trades, not on surviving the game long enough to learn.
Oh, so it's really about survival first, not profit.
Right. Trading isn't about making money first. It's about staying in the game long enough to learn and grow. Everything else flows from that foundation.
So this episode isn't about a secret strategy.
Nope. It's about foundations. The stuff that might sound boring, but literally keeps your account alive.
I love that. These aren't just tips. These are non-negotiables.
Exactly. Skip these, and the market will teach you the hard way.
All right, then. Let's dive into the first one. And honestly, this might be the most important of all.
Yeah. Before you even think about profits, you have to understand risk.
All right, let's start with the one everybody hears about but rarely respects: risk management. Mike, why do experienced traders say this matters more than strategy?
Because strategy makes money. But risk management keeps you alive long enough to use that strategy. Most beginners obsess over entries. They're hunting for the perfect indicator, the perfect signal. But the market isn't a math equation, it's probabilities. Even the best setup fails sometimes. If you don't decide how much you're willing to lose before entering a trade, you're basically reacting instead of planning. And reactive trading is emotional trading. Once emotions take over, fear, denial, revenge, logic disappears. Risk management is simply pre-deciding your worst-case scenario so you don't spiral when things go wrong.
So what I'm hearing is, it's not about predicting the market perfectly. It's about protecting yourself when you're wrong.
Exactly. That's it.
Okay, that makes it clearer. So let's make this practical. If someone has, say, a $5,000 account, what does real risk management look like in action?
Great question. If you have $5,000, risking 1% means you're only willing to lose $50 on that trade. That's it. Not $500. Not $1,000. Just $50. That small limit keeps you emotionally stable. If you lose, it's manageable. If you win, great. But either way, you're thinking long-term. Now compare that to someone risking 20% on one trade. That's $1,000 on a $5,000 account. One bad trade suddenly becomes personal. Stress kicks in. You hesitate on the next setup. Or worse, you revenge trade to recover it. Big risk doesn't just hurt your capital. It distorts your psychology.
That actually explains why people spiral after one big loss. It's not just the money, it's the emotional shock.
Exactly. And trading is already psychologically demanding. If your risk per trade is too high, you're adding pressure you don't need.
So if someone watching right now realizes they've been risking way too much, the fix isn't finding a better strategy. It's lowering their exposure.
Yes. Before you upgrade your system, downgrade your risk. Most accounts don't fail because of bad setups. They fail because one or two oversized trades wipe them out.
That's powerful. So risk management is the rule book.
Right. But here's where it gets interesting. Even when traders say they're risking 1%, they still mess it up. Because they don't calculate their position size correctly. You can understand risk in theory, but if your trade size is wrong, you're accidentally risking more than you think. And that's where the next layer comes in. Position sizing.
All right, Mike. So we just talked about risk, knowing how much you're willing to lose. But even if someone knows that, I've seen traders still blow up. How does position sizing come into play here?
Position sizing is basically how you apply your risk. You can understand that you should risk 1% of your account, but if you enter with too many shares, too many contracts, or too large a lot, you're actually risking way more than you think. It's the difference between theory and execution. Think of it like this: risk is the rule, position sizing is how you follow the rule in real life. It's also psychological. When your position is too big, even small market moves feel huge. Your heart races. You second guess. You hesitate. And hesitation in trading often leads to poor exits, bigger losses, and more stress. Correct position sizing keeps both your account and your mind safe.
So it's not just a math thing. It's also about how you feel while the trade is happening?
Exactly. The market doesn't care about your feelings, but your psychology does. A properly sized position lets you act logically. You follow your plan. You stick to your stop loss. And if the trade moves against you, it's manageable, not a nightmare.
Got it. So let's make this practical. If someone has a $5,000 account and they're risking 1% per trade, how do they decide the number of shares or contracts to buy?
Here's the simple way. First, decide your risk in dollars, $50 in this example. Then, calculate the difference between your entry price and your stop-loss price. Divide your risk by that difference, and you get the number of shares/contracts to take. That's it. Simple math, but hugely important. Most beginners skip this step. They see a stock moving up or down and just buy whatever feels right. That's gambling. Position sizing turns gambling into calculated risk.
Okay, so the bridge is clear. Risk management tells you how much to lose, and position sizing tells you how to implement that safely.
Exactly. And here's the kicker: if you get this wrong, it doesn't matter how good your strategy is. One oversized position can wipe out months of disciplined trading. Size matters as much as timing, indicators, and entries combined.
All right, Mike. So once someone masters risk and position sizing, they've got the foundation. But I'm guessing the next big challenge is mindset, right? Because even with the right numbers, people still panic or overtrade.
Bingo! That's the next layer: trading psychology. Because no plan survives an undisciplined mind.
Bingo! That's the next layer: trading psychology. Because no plan survives an undisciplined mind.
All right, Mike. So we just covered risk and position sizing. Even if someone does those perfectly, I see traders still losing money. So what role does psychology play in all this?
Psychology is actually the hidden factor behind almost every account blow-up. You can have perfect risk management and spot-on position sizing, but if your mind isn't disciplined, it's almost irrelevant. Trading triggers emotions you don't feel anywhere else: fear, greed, impatience, overconfidence. One emotional reaction can wipe out weeks of careful planning in a single click. Think of it this way: the market is neutral. It doesn't reward confidence or punish fear. It just moves. But your reaction to those moves determines whether you win or lose. Most beginners don't realize that controlling your emotions is just as important as controlling your money.
So it's like, even if your numbers are right, your brain can still sabotage you?
Exactly. And here's a practical example. You place a trade with a tight stop loss. The market dips slightly against you. Some traders panic and exit early. That's fear talking. Others hold on too long, hoping it will turn around. That's greed. Both decisions come from emotion, not logic. The key is to follow your plan, not your feelings.
Exactly. And here's a practical example. You place a trade with a tight stop loss. The market dips slightly against you. Some traders panic and exit early. That's fear talking. Others hold on too long, hoping it will turn around. That's greed. Both decisions come from emotion, not logic. The key is to follow your plan, not your feelings.
Okay, that makes sense. But how do you actually train your mind to do that? I mean, emotions are human, right?
Absolutely, emotions are human. You can't remove them. But you can manage them. One method is to treat each trade like a business decision, not a personal mission. Stick to your pre-decided risk and position size. Keep a trading journal. Review why you entered, why you exited, and how you felt. Over time, your mind learns discipline because it's practicing structure, not just reacting. Another method is preparation. Know your setups in advance, have a plan for unexpected volatility, and accept that losses happen. Mentally rehearsing scenarios before they occur reduces panic and impulsive decisions when real trades happen.
Got it. So preparation plus structured decision-making equals emotional control. Makes a lot of sense.
Exactly. And here's the connection. Once your mind is disciplined, you can actually apply all the risk and position sizing principles we discussed earlier. Without psychology, even perfect math fails. Your mind either follows the rules or breaks them.
So if risk management is the rulebook and position sizing is applying it, then psychology is the referee making sure you actually follow it?
Perfect analogy. Without a referee, the game descends into chaos. And in trading, that chaos costs real money.
All right. I'm curious. After psychology, I imagine the next step is expectations? Because even disciplined traders can get frustrated if they expect to get rich overnight.
Exactly. That's the next topic, managing expectations. How to set realistic goals so your discipline and strategy don't collapse under pressure.
All right, Mike. So we just covered psychology. Even disciplined traders can lose focus if their expectations are off. How important is expectation management in trading?
It's huge. Unrealistic expectations are like kryptonite for traders. If someone thinks they're going to double their account in a month, every small loss feels catastrophic. That pressure forces mistakes, chasing trades, over-leveraging, revenge trading. Even the best risk management and psychology can crumble under the weight of bad expectations. Trading is a marathon, not a sprint. Success comes from consistent small wins, not hitting home runs every day. Managing your expectations means knowing that losses happen, profits won't be perfect, and growth takes time. Accepting that reality protects both your capital and your mindset.
So it's really about patience. Understanding that the market isn't a get-rich-quick machine?
Exactly. And here's the key: expectations should be aligned with your account size, strategy, and experience. For example, a beginner with $5,000 shouldn't aim for $1,000 profit in a week. That's setting yourself up for stress and impulsive decisions. Instead, realistic, achievable goals create a feedback loop of discipline, confidence, and learning.
Got it. So small, consistent growth builds both skill and confidence. That also probably ties back to psychology, right?
Yes. When expectations are realistic, you don't panic on small losses, and you don't over-celebrate small wins. Your mind stays level, discipline stays intact, and your system can actually work. Unrealistic goals are what make experienced traders look back and say, "I wish I hadn't forced myself to overtrade."
And for someone listening right now, trying to be a profitable trader, what's the mental shift they need to make?
Shift your focus from daily income to process mastery. Celebrate following your rules, proper risk application, and sticking to position sizes. Over time, these disciplined actions compound into consistent profits. Think long-term growth, not instant results. Trading isn't about winning every trade, it's about winning overall, consistently.
Perfect. So managing expectations is the bridge between psychology and strategy. Without it, even a disciplined, well-sized trade can feel like a failure.
Exactly. And that naturally leads us into the next topic, understanding market context. Because even the best traders need to know what environment they're trading in: trending markets, volatile markets, news events, to apply all these principles effectively.
All right, Mike. So we just talked about expectations. Even if someone has the right mindset, perfect risk management, and realistic goals, the market itself can throw surprises. How important is understanding market context?
It's critical. The market isn't a static machine, it behaves differently depending on context. You've got trending markets, sideways markets, high volatility days, low volatility days. And each type demands a different approach. Entering trades without understanding the environment is like driving blindfolded. You might get lucky once, but eventually, it catches up to you. News events amplify this. Big announcements, earnings, economic data, central bank decisions, can cause sudden spikes or drops. Even trades that check every box in your strategy can fail if you ignore market context. Understanding context is basically seeing the bigger picture and knowing when to act, when to wait, and when to step aside.
So it's not just about what's on your chart. You have to see the market as a whole. And even watch out for external factors like news?
Exactly. Let's say you're trading a stock with a tight stop loss. A small piece of news can trigger a spike that hits your stop before the market settles. Without awareness, that trade looks like a failure, but it wasn't your setup, it was timing and context. Being aware allows you to adjust position sizes, avoid certain trades, or simply wait for a calmer environment.
Got it. So knowledge of market behavior plus news timing equals smarter decision-making.
Right. And it also ties back to psychology and expectations. If you understand the environment, you're less likely to overreact emotionally. You accept that volatility is normal and plan for it. You don't panic when the market spikes, because you know it's part of the game. Context helps turn potential chaos into predictable patterns.
So for someone listening, what's the practical takeaway? How do they apply this without overcomplicating things?
Start with two things. First, identify the type of market you're in, trending, ranging, or highly volatile. Second, always check for scheduled news or economic events before entering trades. Combine that with your risk and position rules, and you can survive, even thrive, in unpredictable markets. Small, smart adjustments based on context make all the difference.
Perfect. So market context is the lens through which all our previous principles, risk, position sizing, psychology, expectations, are applied.
Exactly. And that naturally brings us to the last two topics, discipline and survival mindset. Because no matter how smart you are with context, without discipline, the system still falls apart.
All right, Mike. So we just covered market context. Even if someone understands the environment, I notice many traders still fail. How important is discipline and consistency in trading?
Discipline is literally the backbone of trading. You can have perfect setups, position sizing, risk control, and market knowledge, but if you don't consistently follow your rules, it doesn't matter. Consistency isn't sexy. People want quick wins. But trading is a game of repeated, disciplined actions. One trade doesn't make you a winner or loser, your behavior over hundreds of trades does. Consistency also trains your psychology. When you follow your plan day in and day out, your mind learns to trust your system. You stop panicking when the market spikes or dips. You stop chasing losses. Over time, Discipline builds both skill and confidence. Without it, even the best strategy fails because emotional decisions creep back in.
So it's really about habit, right? Following the plan repeatedly until it becomes second nature?
Exactly. Trading isn't about perfection in a single trade, it's about perfection in process. The more consistent you are, the less luck and emotion dictate your results. Discipline also reinforces all the other principles we've talked about: proper risk, position sizing, realistic expectations, and reading market context. Without it, everything falls apart.
Got it. But what about when someone has a losing streak? How do they stay disciplined when emotions are high?
That's where consistency really shows its value. Discipline isn't ignoring emotions, it's following your rules despite them. Accept that losses happen, they're part of the system. Stick to your risk limits, position sizes, and plan. If you break discipline after one loss, you undo months of good habits. Consistency smooths out these emotional spikes and keeps your account alive.
So in a way, discipline is the glue that holds everything else together: psychology, expectations, risk, position sizing.
Exactly. And that naturally leads into the last topic: survival mindset. Because even with discipline, there will be periods of stress, drawdowns, and unexpected events. Your survival mindset ensures you stay in the game long enough to see the rewards.
All right, Mike, we've covered risk, position sizing, psychology, expectations, market context, and discipline. But even with all that, I know some traders still fail. So what's the role of the survival mindset?
Survival mindset is everything. Think of it like this: trading isn't just a game of skill, it's a game of staying alive long enough to see your skill pay off. Even the best strategies, perfect position sizing, and disciplined execution won't matter if you let one emotional trade or unexpected market move wipe you out. Survival mindset is about protecting your capital, controlling losses, and knowing that staying in the game is your first victory. It also ties everything together. When you maintain this mindset, you respect risk, follow your position sizes, manage your emotions, stay disciplined, and keep realistic expectations. It's the invisible thread connecting all the principles we've talked about. Without it, even small mistakes compound into disaster.
So it's not about making a fortune on a single trade. It's about staying in the game, learning, and compounding wins over time?
Exactly. Beginners often chase instant success. They want to be rich in a month. Survival mindset teaches patience. Slow, consistent growth beats reckless ambition every time. Your goal isn't just profit, it's longevity. If you survive the market's ups and downs, profits eventually follow.
And for someone listening right now, what's the single most important thing to remember?
Prioritize staying in the game. Apply risk management, size your positions correctly, control your emotions, keep realistic expectations, understand the market, follow your rules consistently, and respect your capital. If you can survive, all the other wins will naturally come. Focus on survival first, and profits second. That's the difference between traders who fail and traders who make it long-term.
Perfect. So in summary, these 7 fundamentals of risk, position sizing, psychology, expectations, market context, discipline, and survival mindset aren't just tips. They're non-negotiable rules for anyone serious about trading.
Exactly. Skip one, and you expose yourself to failure. Follow all, and you build a foundation that can withstand any market. Trading is hard, but with these principles, you can make it.
All right, folks, if you take away anything from this episode, remember, trading is a journey. Respect the fundamentals, stay disciplined, and above all, survive. That's how you win.
Absolutely. And if you practice these consistently, trading becomes less about luck and more about skill. Stay patient, stay focused, and stay in the game.
So, Mike, after covering all 7 fundamentals of risk management, position sizing, trading psychology, expectation management, market context, discipline, and survival mindset, what's the key message for traders listening right now?
The key message is simple. Trading isn't about chasing quick wins or finding a magic setup. It's about building a strong foundation and following it consistently. Each of these 7 principles reinforces the others. Ignore one, and your account and confidence are at risk. Apply all, and you give yourself the best chance to survive, learn, and grow your trading career over the long term.
So it's really about process over outcome, focusing on what you can control, and letting results follow naturally?
Exactly. Focus on what you can control, how much you risk, how well you size positions, how disciplined you are, and how you respond emotionally. Let the market do its thing. If you survive, you learn, you improve, and profits will come. Patience and consistency beat shortcuts every time.
All right. And for beginners feeling overwhelmed, any final advice on how to implement all this without getting lost?
Start small. Pick 1 or 2 fundamentals and master them before layering in the rest. Keep a trading journal. Review trades. Track your psychology. Apply rules consistently. And above all, remember, it's a journey. Every trader started as a beginner. Survival first, growth second, profits later. Focus on that, and the market becomes your classroom, not your executioner.
Perfect. Folks, if you remember anything from today, remember this: trading is a journey. Respect the fundamentals, stay disciplined, manage your emotions, and above all, survive. That's how long-term success is built.
Absolutely. Practice these 7 principles consistently. Trade smart, protect your capital, and let the learning compound over time. Stay patient, stay focused, and stay in the game.